Good morning and welcome to our Mortgage Fund, Freebies, and Forbearance webinar with David Luna and Rob Chrisman. Please let me introduce to you the president of CAMP, Ms. Audrey Boissonneau. Audrey?
Good morning and thank you so much, Megan. I really appreciate it. I welcome everyone to the webinar and thank you so much to Dave Luna and Rob Chrisman for joining us. Just a few housekeeping things before we start. We've been busy. Very busy. We've been putting on webinars. We're very interested in hearing from you about what you want to hear about. So please keep in touch with us on that. We have been asking the governor for him to please enact the ability to do online notaries. We are counsels about the impact of their ordinances on consumers and the mortgage industry at large. And those conversations keep happening all over the place. It keeps expanding as this all rolls out. We would like to invite you to be members of CAMP. We're going through our renewal process right now. So if you're a new member or have any questions, please let us know. We're here to help you always. And with that, let's start with what happened in the last week, David Luna.
Oh my goodness. If you remember last week, we were looking at jobless claims over 3 million, revised up to 3.3. Then we went to 6.5. We went from 3.3 million to 6.5. So we got 10 million people unemployed. Wow, that wipes out pretty much all the jobs created over the last 5 years. Some are thinking that unemployment is going to go up to 40%. Guys, I don't think so. So when the worst is past us and we get to go to restaurants and have a nice meal, I think all of those unemployed folks in the service sector will be back. I think you still have a lot of tech people. I just finished with a webinar in Silicon Valley, and a lot of the tech people are still working. And I think the doom and gloom, oh my goodness, there's millions of people that are gonna, guys, FHFA Director Dr. Calabria, speaking on Fannie and Freddie, when he did a CNBC interview this week, he said, you know what, maybe 2 million would be seeking mortgage help. That's a little bit more like 3 to 5% of the market instead of 25%. So I'm going to agree that I think some people are blowing this out of proportion. Please don't think it's not serious. It is. If you guys can see that green cancer, thing, my daughter's got cancer. December at 23, she said, Dad, I've got cancer. She has gone on chemo and she can't leave her house and her husband can't go out to get groceries either. This is serious. I'm not trying to make light of it. I'm just sitting there saying, I really don't think things are going to be as bad 2 weeks, 2 months from now as what we're seeing today. Rob, what are your thoughts?
I would, well, obviously nobody has a crystal ball, David. The fact of the matter is, a lot of people ask me about how this compares to 2008, 2009, 2010. And really the severity and the ferociousness of what we've experienced just within the last month has been incredible. It hasn't been a 2008 situation where, 2006, 2007, things started to go awry, programs started to disappear, companies gradually, phased out, quantitative easing was introduced. It's been a, instead of like a wrestling match, it's been a, punch in the face for not only the US economy, but the world economy. I think recovering from that, I like to think that it's, people are talking about, a U-shaped recovery or a V-shaped recovery kind of thing. Hopefully it's not an L-shaped situation going forward. It's gonna take a while before these jobs come back. And to your point, I agree that especially in the service sector and the hospitality sector, I want to go to a restaurant and sit in fact, one of my commentaries coming up is going to be, how much I miss like sitting there looking at a menu with people in the restaurant and like, wow, look, there are other people around us, that kind of thing. Or I want to get my house clean. I want to have gardeners back in the yard. I want to, get my nails done. Well, maybe not my nails, but the service sector has been particularly hard hit. Interestingly enough, I think if you start looking at the statistics, a lot of those people may not have mortgages. So when you talk about forbearance, and I'm sure we'll be talking about that here today, but I think a lot of them, especially the hourly people, may not have mortgages. And so I know that Mr. Cooper announced some preliminary statistics just yesterday or early this morning, talking about what numbers they're seeing in terms of forbearance. But in terms of the economy and bouncing back, I'll put on my optimistic hat here to some extent and say I hope it's a V. I hope it's a pause, PAUSE, rather than some kind of a lasting impact. But it's going to be felt for a while, and I think it's definitely going to change some things for the worse and for the better. Frankly, I think that a lot of companies have really boned up on their contingency plans, their emergency plans, work from home plans. I think that the workforce may change here a little bit. Gee, I can work from home, and from what I'm hearing, people are very productive from home, so that's good. But to get back up to speed, I think it'll take a little while, and I think that we don't know when the all clear whistle will blow. Who's going to blow the all clear whistle? What will make it safe to fly, to check into a hotel, to go to a restaurant, for us to walk around outside in the downtown, go into a store, et cetera. Who's going to tell us that it's okay? I think that'll be interesting. I think that's what a lot of people are waiting for.
Yeah. So some of the questions, and I agree, Rob, some of the questions that we had from last week about non-QM and jumbo, just short and sweet, they're pretty much gone for right now. There may be some larger lenders still in the marketplace, but I think they're getting fewer and fewer. Another question that was asked was on credit reports and forbearance. Now, to get us back onto the topic, as I said before, there will not be a reported non-payment or derogatory mark on a borrower's credit report. So from the CFPB on April 1st, so 6 days ago, they gave further guidance on what we shared last week. So from the CFPB's website, quote, the act, meaning the CARES Act, requires lenders to report to credit bureaus that consumers are current on their loans if consumers have sought relief from their lenders due to the pandemic. The Bureau's statement informs lenders, listen carefully, that they must comply with the CARES Act, end quote. So on a point of clarification and a little bit to our title, freebies and forbearance, I just did a presentation to realtors where they were asking, what do we tell our customers when our customers call us up? We have to everybody remember, forbearance is not forgiveness. And the CFPB actually sent out a YouTube video on April 2nd about forbearance. So let's super quick talk about the difference between the forbearance and deferral of mortgage payments. So I'm building on what we covered last time, not doing a repeat. So if there's questions that somebody missed last time, we'll be happy to answer those. So forbearance, let's make it California. Let's make it a certain young lady that I know in the San Francisco area. She's got a $4,000 a month payment. Under forbearance, all missed payments are due when the payments start again. So if she skips $4,000 for April, $4,000 for May, $4,000 for June, and makes her first payment on July 1st, that's $16,000. And I'm just thinking, if you couldn't make a $4,000 payment in April, what makes you think you're going to be able to make a $16,000 payment in July? So there's a little bit of a disconnect. I think what the consumers are thinking, like when the Fed funds rate was dropped to 0 or almost 0, we had people call us up. Does that mean I get a 0% mortgage? I think what the public understands, what industry understands, and what reality is a little bit of a disconnect. So I'm grateful for Camp for putting this together. So forbearance is not free, and forbearance is not deferral. Deferral means that we take the payments that were missed and maybe we put them at the end of the term, or maybe they're due when the loan is either paid off due to a refinance or a sale. So short and sweet, that's the difference between forbearance and deferral. Please be careful with the words you're using. Rob?
Yeah, I don't have anything to add to that, David. I think that's very thorough, and I think it's important for people to understand the difference, certainly, and even more so to educate their borrowers. I think that there is a lot of uncertainty right now with regard to the servicing side of things, and we're all getting a lesson in how the secondary markets determine the primary markets. Once again, when you start losing investors or when warehouse lenders start becoming nervous, it really doesn't take the programs long to dry up and the companies to scale back or switch to something, originating something else. And with regard to the forbearance, this has all happened so quickly. I think there are a lot of questions that the industry has, and certainly a lot of questions that servicers have, and certainly a lot of education that servicers and lenders have to give borrowers. Whether or not they understand it remains to be seen. But yeah, obviously the difference between deferral and forbearance is huge. And you're right. I don't think that people are going to come back in 4 months or 3 months or 6 months and pony up 16 grand or whatever it is. I don't see that happening. And I think that question or that issue will be addressed at some point by the agencies or Ginnie Mae. So yeah, it is an important difference.
I want to bring the audience up to speed on what maybe Rob just quotes in his sleep, or what I might know just by doing extensive research. So this is the problem that's going on out in the industry. So what happens is you have the public that's hearing, oh, I don't have to make a payment. Well, the servicers still have to pay their investors, okay, the payment. So if they're not getting a P&I payment, and nobody's even talked about insurance, taxes, or escrows, right? They have to pay these things out, but they're not receiving any kind of revenue in. And so there's that concern. And so that's why you have a little bit of market compression going on about payments. There was a little bit of a relief this past week when Jenny says, we've got you. But I haven't heard anything about Fannie and Freddie. Rob, have you heard anything about some sort of an ability for Fannie Freddie to say, hey, even though you don't have the income coming in, here's a pile of money you can draw from. Yes, we'll charge you interest, and yes, we have to figure out when you're going to pay it back. But I see that for Jenny, but I don't see that for Fannie and Freddie. Rob, have you heard anything on that?
I've heard that it's under consideration by the agencies, trying to figure out what to do about that. The Ginnie Mae fund that you're talking about has been used in certain incidences around the nation, maybe a hurricane or an earthquake or a flood, to address the needs of a relatively small group of borrowers or servicers in this case. When you're talking about a national set of servicers, with 10 or 15 trillion dollars of mortgages outstanding, and how many of those are going to want forbearance, and how many of those are FHA, VA loans, and so forth, and what is the monthly FHA, VA payment that servicers are on the hook for nationwide, and what percent of those are not going to be making their payments. I mean, the numbers become staggering and very complicated fast. And I think, well, I know that when Ginnie Mae made their announcement, or made its announcement about a week or so ago, they said over the next 2 weeks we're going to put together a proposal and really flesh out some of the details that are lacking, or most of the details, hopefully all the details that were lacking in their initial statement. And I've heard that Fannie Mae and Freddie Mac may be waiting to see what is in that or in those details before they come out with a similar plan. And because it's nice to think that we're all made out of money, including the U.S. government, and obviously the U.S. government and the Federal Reserve had to step in because of this pandemic. But the money's got to come from somewhere at some point, and so we'll see how it goes. But yeah, in terms of fleshing out the details from Fannie Mae and Freddie Mac, I think they're working on that, David.
Agreed. The day we did the webinar last Tuesday, Fannie and Freddie made new announcements regarding documentation. So you're seeing overlays or underwriting guidelines just kind of tighten up. LTVs have gone down. Credit score requirements have gone up. Dates of income and asset docs have just gotten tighter. And then the self-employed borrowers, wow, it went from say 120 days to 10 days with the verbal verification of employment right there before funding. Where nobody wants to travel. Governor Newsom says, we gotta stay in place, and so now we get to see how cool Rob's house is.
I don't know about that.
Now they're saying that we can do a 2055, which is an exterior only appraisal. So there's a lot of different overlays that are being created, but nothing that I'm seeing is lasting longer than say mid-May, third week of May. Nothing that says okay now and forever. So this is a temporary thing, and I think especially in this environment, it just makes sense. Rob?
Yeah, obviously, the big difference that we're dealing with now versus 2008 is the health and lives of citizens and people around the world. A lot of companies, a lot of very good companies established, I would call them playbooks in 2008, 2009, 2010, ways of handling certain things. And I think that a lot of companies are going back to those playbooks and saying, okay, this is what we did and this is why we did it and what do we need to do now. I know many companies out there shut down jumbo right away. They shut down non-QM right away. I'm oftentimes asked about non-QM and when is that going to come back? When is non-QM going to come back? And I think that one of the big issues is that there was uncertainty in the investor set among some of the guidelines from non-QM lenders. This lender or this investor may take 1 month's worth of bank statements and they say that borrower meets the ability to repay. This other investor doesn't. So there was this hodgepodge. It's important, I think, for folks to remember that in May next month, which is just next month now, the CFPB is expected to release their proposal to eliminate the non-QM patch. And I think the non-QM market is waiting not only for us to get the all clear whistle with regard to the health crisis, but also to see what the CFPB says with regard to what is the difference between a qualified mortgage and a non-qualified mortgage. Is it reserves? Is it payment history? Is debt to income ratio? I mean, is that still a factor? So there's not only uncertainty with regard to what's going on in the global health environment, but also with regard to the regulatory environment. With regard to the jumbo program, that's slightly different. Jumbo investors, there've always been, the Wells and the Chase and the Redwood Trust and the PenFed and some others that take the lion's share of jumbo market or the jumbo market. And I think that Wells Fargo, by scaling back their jumbo program, that was an asset cap issue, not a credit issue per se. Redwood Trust, a little bit different. They need that secondary market and their investors, their shareholders, to really embrace the jumbo market. And so we'll see what happens with jumbo. I think that'll come back more quickly than non-QM. And obviously, oh, I'm sorry, go ahead, David.
I said I would agree.
Okay. FHA, VA, to your point about forbearance and are these servicers going to be able to come up with money and so forth, that is a huge question mark. And as the value of Ginnie servicing went from about a point down to zero in the matter of a day, and really called into question, are lenders going to continue to offer this product that in effect is backed by the full faith and credit of the U.S. government? And so if you're a money manager somewhere, you like knowing that Ginnie Mae securities are backed by the government. Then the question is, how's the servicing going to work? How's the forbearance going to work? Lots of questions that Ginnie Mae is going to answer. So I think a lot of lenders out there are still offering products, FHA, VA, Fannie Mae, and Freddie Mac. With regard to the other programs, I think they are idling or on hold, and I think they probably will be for another 2, 3, 4 months, maybe 5 months. Certainly until we get non-QM figured out, and certainly I would say that if the U.S. government came back and said, "Hey, Wells Fargo, we're gonna loosen up our shackles here a little bit with regard to your capital and your asset holdings and so forth," I think Wells would come back into the market, because I think those investors of jumbo products like that product. It's a good, solid product, good underwriting, good borrowers. They like having those borrowers as clients, so it's a good product to have. I think the jumbo market will come back faster than we think. The other product, the government-backed product, Fannie Mae, Freddie Mac, FHA, VA, I think a lot of lenders will continue to motor through. I was just on a MBA Stratmore call, and everyone's pipelines are very full right now. They're very full, and they are lending money. They are doing a lot of refinances. They figured out, whether or not the county recorder's office is open. They figured out how to do the appraisal. They figured out how to do the verbal VOE. They figured these things out, and they're forging ahead. They're making sure that they help their borrowers, and that's what this industry is all about.
I agree. So a question from last week is what's happening with mortgage interest rates? I mean, the Fed funds rate, 10-year, MBS, hedging, margin calls, servicing, COVID-19, they all play a factor. I think there's been a huge disconnect, but I think things are starting to line back up. There's still uncertainty in the industry, like you said. I'm going to differ with you as to how long it's going to take. I think you have a longer feel. I think yes, it'll be months, but I think it'll just be a shorter feel. But because we're friends, I'm not going to argue with you.
David, I hope you're right. I seriously hope you're right. Things have happened so fast. If I look back at if you and I were having this session, a month and a half ago, it would have been an entirely different discussion topic. The industry and the economy, has moved so fast. I hope that it moves so fast in the positive direction. But I think, like I said, this is unlike 2008, which is more of like a wrestling match that we were dealing with, and this is more of a rock'em sock'em robot fight where the industry's been hit, been socked, been punched. I think it's going to take a little while to recover from that punch. So, anyway, but I hope you're right.
Let's see what happens. So when you guys are asking us about rates and things like that, I mean, Rob and I aren't Barry Habib. But just to give you a little bit of a history, for the last 5 years, rates were about 1.75% above the 10-year yield. Last month, oh my goodness, they were wildly off, and that uncertainty and nervousness about the future, that was crazy. I'm starting to see rates drop again with the 30-year at approximately, and you guys can argue with me, but I look at the country as a whole, and I'm kind of seeing 30 years at approximately low 3s, 15, high 2s. I think when things come back together again, I think we actually are going to see rates lower than what we are seeing today. But just understand, folks, we normally will do $1.5 trillion, $2 trillion of business. Heck, if everything was clicking, maybe $3 trillion in a year. Right now with pipelines, like Rob just said, I mean, pipelines are full. You have maybe $5 trillion trying to move through the system, but not in a year, in 2 months. And so I think you need to really set expectations with borrowers out there that it's going to take some time. In fact, the refi business is very, very strong. It's up almost 170% over last year at this time. So I think things are going to change, and I'm going to be quiet for a sec, give Rob the last word here, and then I think we wanted to have time for questions from you. Rob, what do you think about rates? When do you think they'll be back? What does your crystal ball say about the future? Rob, I recently changed the batteries in my crystal ball, so I've got a full charge on there. I think rates, again, because of debt, we have an additional $2.2 trillion of debt on top of the deficit we had before. I think we're going to be in a low rate environment for quite a while.
Well, I don't know where to start, David, but I'll start by saying this. When I first got really involved in capital markets was at Tuttle and Company, back in the 80s. And Paul Tuttle used to tell the story about when he was at Kidder Peabody. Remember that name, Kidder Peabody?
Oh yeah.
And
I remember Rock'em Sock'em.
There you go. He would advise his clients, or there was a story about a money manager who, for every decision, he would tell half his clients to do one thing and half his clients to do another thing, and then something would happen, and half his clients would think that money manager was a god, and then something else, some other decision point was coming up, and he'd tell half of them one thing and half of them the other, and then whatever happened would happen. And so he would winnow down these clients to like 5 or 10 clients who thought he walked on water because he had made, it was just luck of the draw. On the trading desk, we used to keep a coin, and when clients would say, "Hey, we've got, a bunch of people want to know if I should lock in tomorrow, what should I tell them?" We'd literally flip a coin. Heads rates are going up, tails are going down, and sometimes we'd be right and sometimes we'd be wrong. I'm glad you replaced the batteries in your crystal ball. Somewhere, I think in back of me somewhere is probably a Ouija board. Really, I would argue that nobody has a crystal ball. If you go back to the bubble way back when, who called that and who didn't. With regard to a couple months ago, who thought a pandemic would do this to worldwide economic markets? Obviously, there are some people who think rates are going to go up from here. Some people think they're going to go down. I'm of the camp that they're going to stay here for a while, just because there's really no reason for them to go up. The worldwide economic situation is such that. Hang on here, I've got a visitor.
Myrtle?
No, this is actually
Myrtle.
Gusto. Yeah, there's Gusto.
Oh, Gusto. Sorry.
That's all right. That's all right. So the question that I think listeners need to pay attention to is what is going to move rates, rather than trying to make a prediction on rates, because I will always make the argument that you shouldn't bet your company's future on somebody's rate prediction. I see a lot of individuals out there who are going through their business models. They're closing one loan at a time, regardless of what rates are going to do. But I think it is important for listeners to know why rates are doing what they're doing and why they came down, and why the market is so disjointed, and why there's been this decoupling between mortgages and treasury securities because of supply and demand issues, and because, once again, the worldwide economies have been socked by this terrible disease that just popped up a few months ago and has really wreaked havoc everywhere. And so now the question is, where do we go from here, and how do I prepare for it? I think so many people out there have their heads down, and they're trying to help their borrowers in their pipelines. They really don't have an eye on rates per se, but I think that mortgage rates are going to come down. And to your point, I think the volatility in the treasury market and the volatility in the mortgage market, and some days I'd be looking at my screens and I would see treasury prices up a point and mortgage prices down a point, and vice versa. And there was this disconnect. I think that is going to quiet down. We're already seeing it quiet down to some extent. I think nobody likes volatility like that. Nobody likes volatility. Certainly not lenders, and certainly not capital markets people who are trying to hedge a pipeline. And the big question that I'm hearing among lenders out there right now is this pipeline that I have, is it real? Are these loans going to fund? Can these borrowers that I have locked in, I've got 20 loans in process, can these borrowers make payments? Do they have the ability to repay? Or is my company hedging a bunch of loans that I shouldn't have, that shouldn't be locked, and that we shouldn't have a hedge on, enduring the volatility that we're seeing in the mortgage-backed security market? So in the trenches, what I'm seeing is companies really trying to make sure the pipelines they have are clean and viable, and those loans are going to fund. In the capital markets area, you just have a lot of capital markets people who have been, beat hard and put away wet. They're just waiting for things to calm down a little bit. We're seeing them calm down a little bit, and I think when things calm down and the volatility decreases, I think we will see, to your point, mortgage rates come back down a little bit or a lot, depending on how things go. Because like I said, right now, and as everybody on the call knows, I think the economy isn't in great shape. You know, so many people, tens of millions, are going to be out of work temporarily. People aren't spending money. I just got my credit card statement today, and I looked at it and I thought, holy smokes, you know, look at this. I'm not spending any money. That's great. I think a lot of people are in that situation where they're not going out and spending much money. They're not buying, you know, they have to eat, but they're not, you know, going to fancy restaurants. They're not traveling. I think a lot of companies are out there saying, wow, look at all the money we're saving on our marketing budgets. We don't have to send people to different places. A lot of this is being done by phone. So there's a shift going on in the economy. I think that it's important for listeners to understand what's going on with that shift and try to anticipate, okay, how are we going to come back? What kind of jobs are going to come back? What impact is that going to have on the economy? I don't think that, well, I think everybody has an opinion, and I like to think that we're just pausing right now, and we are going to come back because I think that people who wanted to buy a home in December or January or February for $300,000, they want to buy a home. They still want to buy a home. And the fact that they're stuck in their apartment and they can't go out and look at open houses, they can't deal with a realtor and so forth. When that goes away, I think they'll still want to buy a home. And I think that things should bounce back. But I do think rates will be low for a while, just because of the hit that the economy's taken and the hit that, you know, not only our economy, but the worldwide economy. So I you know, to your point, I see rates staying low and perhaps creeping down. And I think the lack of volatility will help rate sheets and help drive mortgage rates low relative to mortgage-backed security prices and relative to treasury prices.
Yeah, every day when you kick out your newsletter, by the way, ladies and gentlemen, if you're not getting Rob Chrisman's newsletter every day, you're doing yourself a disservice. But every day, you almost every day, you at the bottom talk about what's happening with, you know, 10-year securities and how it's better or worse from yesterday and things like that. I agree. I think things will become less volatile in the future. And I think for most of everything we're talking about, we're saying the same thing. So I think we've got some questions from the audience. It's not, you know, I'm not the moderator or host or anything else like that. You just have two guys that just happen to wear the same blue shirt this morning. By the way, that wasn't planned. Visit with you.
So hold on, Dave, I need to interject a little bit of humor here. So I got this text.
I love your humor, by the way.
What's that?
I love your humor. At the end of all your stuff, my wife is still rolling around the floor when he says, and the dart went behind the refrigerator.
Oh yeah, there you go. Yeah, the opening paragraph stuff's pretty good too, but I got a text yesterday. I've got to figure out how to work this into my commentary from a friend of mine whose wife is saying, okay, it's time to wash your sweatpants. And he's like, well, I've only been wearing them for like 3 weeks. And so I've got to figure out how to work that in, because when I went off and started, you know, when you're doing your own laundry, you know, underwear and socks and so forth, you wash that stuff all the time. Shirts, not so much. Pants, geez, there's some pants I probably have that I never washed. They never got dirty, right? They didn't get dirty. Anyway, this is a nice clean shirt I got on for you.
Oh, thank you. I appreciate that. Madam President, do we have questions from the audience?
Oh my gosh, can I just start with, for God's sake, people, take a shower, clean your clothes, brush your teeth. Geez Louise. Yes, we have a lot of questions, so I'm going to ask you guys to be concise and keep your answers short but thorough and accurate. Nice little kitty. So can you expound a little bit on the Ginny deadline of April 15th? Obviously we're hearing talk, oh yes, they've said that they're going to take care of everything and everything will be fine, but there have also been comments made by politicians saying we're not bailing out the banks. Can you go a little further into that and what you believe will happen? And I know what we hope will happen, but how realistic is it to expect that the government is going to step in and take care of that?
Who's the question for, Rob or myself?
Just dive in, people.
Just a question. David, why don't you start?
I don't know that they're saving banks. I think that the thing is, it's the type of loan and the servicer on that type of loan. So again, if we're talking more like government type loans, yes, they have said that yes, they are going. Okay, so you have the company, the entity, the lender, the bank, whoever that is, have a pile of money, and they're lending that pile of money, which makes the pile of money get smaller and smaller and smaller until one day they don't have any more money. So now they have to sit there and ask, okay, who do I get more money from? So that spigot has been turned on, at least on the government side, so that they can now get more money to lend to more people. That spigot hopefully will be turned on for the conventional side, but it hasn't happened yet. Rob?
Yeah, I would say that. So let's go back to the Depression. And no, I was not alive during the Depression.
Let's do that.
It was 1929. No. The government stepped in, created Fannie Mae, for example. The FHA, VA programs got their start during the Depression. The government stepped in and did what they had to do. I think that many economists and regulators and politicians look back at that and say, okay, this is what the government did. And there were certainly people who disagreed with the amount that the government stepped in during the Depression, just like there are a lot of people who disagree with the amount that the government stepped in 2008, 2009. Should the government have done what it did then? What the government is doing now will be debated for a long, long time because people like debating about that stuff. I don't think anybody at this point, given the pandemic, will disagree that the government had to do something. Whether it's the federal government or the Federal Reserve, Congress, $2 trillion package. To David's point, at some point you start to think, all right, well, are they going to run out of money? Is this a short-lived thing? And if it's short-lived, will the government be paid back? You also have the question about banks versus non-banks, and I don't know if that's where the questioner was going with that question about saving banks or saving non-banks, and should the government really help non-banks survive? Should it help non-banks service loans? I think that if you were to step in and say, all right, Quicken, Freedom, Loan Depot, United Wholesale, you guys are on your own with regard to coming up with the money for FHA, VA loans where the borrowers can't make their payments and those companies have to send the payments to the investors. I don't think that is a recipe for success in this kind of environment. I think the government, there's some pretty smart minds out there that are figuring these things out. I think it is short-lived. I think they're doing the things that they need to do. I think the industry and groups like CAMP or the MBA or the California MBA or whoever it might be, I think are doing the things or saying the things that they need to say to the politicians and Congress and so forth and the Federal Reserve, and letting them know that this industry is really being hit hard. It could be hit a lot harder, and it's not in the best interest for the U.S. government to see a lot of these companies go out of business or declare bankruptcy because they couldn't come up with the payments. So
Housing Wire, oh, sorry, Rob. Housing Wire has an article out today, like 3 seconds ago, where Mr. Calabria said that Fannie and Freddie have plans to address the concerns being raised by the mortgage businesses over services' ability to handle widespread forbearance, but it's not the one the industry is calling for. So the next week, tune in next week, guys. It's going to be interesting to see what happens, but there's a lot of questions around that. So the questions continue. There are a lot of questions about EPOs right now because obviously there's concern that if somebody goes into forbearance and they have just closed their loan, that the loan cannot be bought, will not be purchased on the secondary market. And then people are asking, will EPOs be triggered if borrowers exercise forbearance? Let's talk about that. Let's talk about EPOs, and let's talk about the fact that lenders are already sending notices to brokers and and retailers that they will not purchase loans if the borrower goes into forbearance once the loan is closed. And how long? For how long?
I'll jump in, David. I know that for a fact, and Fannie Mae and Freddie Mac will not purchase loans that are in forbearance. That's their policy.
Right.
And so for an investor, a large correspondent investor like a Wells or Chase or AmeriHome or PennyMac to fly in the face of that kind of pronouncement doesn't make any sense. Now, that's not to say that Fannie Mae and Freddie Mac may not change that in the future, but Mark Calabria has, you're dealing with somebody, if you go back in history a little bit, he's never been a, well, how do I put this tactfully? He's,
good luck.
It's got a little bit of the school of hard knocks with regard to Fannie Mae and Freddie Mac, and should they be scaled back? Should they really be part of the government? Should they be this, that, and the other thing? Should they just go away? I mean, he's taken a hard line in some of his approaches or some of his writings in previous years. Now he's dealing with a lot of the reality of the entire, or almost the entire mortgage industry. And I think that he's toned things down a little bit, but that's not to say that he might not think along those lines. But I would expect, like I said, I don't think it's in anybody's best interest to have a huge number of lenders go out of business, a huge number of borrowers not be able to make their payments, and we don't want a bunch of short sales like we had 10, 12 years ago. So David, I'll turn that over to you.
We call him Mark Calabria, but it's Dr. Mark Calabria. I mean, I agree with Rob. He's a smart guy. And so on previous writings, and then I think the industry was surprised when they made him director of FHFA, I agree. So I haven't had the opportunity to read whatever came out, Audrey, like 3 seconds ago. I hope there's a solution for Fannie and Freddie. I just haven't seen it yet.
So there's a question about the big national banks having a price advantage if they're able to portfolio their loans. And I had a realtor send me a client this weekend who had been in the process with Wells Retail, and Wells Retail told them they weren't doing any more refinances. So Rob, do you know about this? And can you speak to, either of you can speak to whether you think they're going to have a pricing, whether lenders who are portfolioing their own products and lending their own money will have an advantage?
Okay.
So I think that they've always had an advantage. I mean, in the most basic sense, if you were a bank and I put my money in the bank and I get 0% on my checking account, and they take my $30,000 in my checking account and combine it with David's and combine it with yours, Audrey's, and combine it with everybody's, and they start loaning that out at 3 or 4 or 5 or 6% or whatever percent. I mean, they have the advantage of being able to set their margins and evaluate the rate of return on a mortgage versus what they're paying in checking accounts and so forth. And there are other lines of business in tough times can support the mortgage side and vice versa. So depository banks have always had a bit of an advantage because their warehouse line, which is themselves, is very low compared to what a warehouse bank would charge an independent mortgage bank. That said, independent mortgage banks are very nimble. They are very quick. They are very good at what they do, and they are very good in the capital markets, and they play to their advantages. So they have advantages that, let's say, a large bank may not have. In terms of the financial structure of the United States, independent mortgage banks kind of come and go. The Chase, the B of A's, the Cities, the Wells, and so forth, the U.S. banks occupy a predominant place in our industry. That's not to say, though, that they always have the competitive advantage. And in fact, when you look at banks' 30-year mortgage rates compared to somebody else's mortgage rates, like whoever, oftentimes they won't have the best rates in town, and there's a reason for that. And I'm not going to get into the whole the reason why, but they do have an advantage, and they do have an advantage if they want to flip a switch and do so. Now, there are a lot of rumors about what products they're offering. I think for a while there, people were asking me, gee, I hear Wells Fargo has gotten out of doing refis. I will say no. They did scale back their jumbo or eliminate jumbo on their correspondent side, but in their retail branches, they're still offering jumbo loans, especially to clients, who have a certain amount of money in the Wells Fargo banking system, who are valued clients. So they're continuing to offer a scaled down version of the jumbo business. I've heard of warehouse banks eliminating refis, not saying we're going to make loans or we're not going to lend money through our warehouse channel on refis. We've got enough purchase business as it is, so we're going to scale that back. So I'm seeing that, and David, you can add in here, but I'm seeing that with a lot of lenders and a lot of investors. They may not eliminate programs entirely, but they are tweaking their minimum FICOs, as you pointed out earlier. They're tweaking loan to values. They're tweaking their geographic areas. They're doing things that fit better to their business model in this time when everybody's being deluged with business.
Yeah. So 19 hours ago, I'm part of a mastermind group, and someone posted a $750,000 loan at 3.25, and we're not talking ARM. We're talking just regular, normal, straightforward. And the conversation among the group was, how can they do this? It was a bank. Seeing that they're not a sponsor of camp, I'm not going to mention their name, but we are seeing that those lenders that can portfolio, that have the means to hold the loans and don't have to sell them, for cash flow. Yeah, to Rob's point, they can be more competitive on pricing, especially if they're getting it for almost nothing, whatever it is that we're getting paid on our checking and savings with Brand X Bank. So they will have sometimes a competitive advantage, but again, it's just kind of temporary. So what we have to be super careful about is not take a picture of what's going on today and assume really that's our world. Audrey, you asked me to do this again from last week to this week, and our world has changed in a week. I think in a month or 2 months, I think the world is going to change, a mortgage world. I think it's going to, continue to be different than what it was, guys, a month ago in the mortgage world. It's different than what we're doing today.
Well, and just remember, Dave, that we'll be doing this again next week on Tuesday at 11 a.m. because you promised to keep us informed on a weekly basis. So just make sure your calendar's marked, buddy.
Yes.
So can we briefly talk about high balance pricing? Because although it falls under Fannie Freddie umbrella, that pricing is something else. So why is there such a disconnect between the baby conforming and the high balance, or whatever you want to call it?
It's market appetite. It's what will somebody buy? And then you're seeing some creative bolt-on things going on right now. For example, if the loan amount is too high, then what we're seeing some creative people do is they'll do maybe a regular normal conforming first with a bolt-on second to hit the higher number that we need to consummate the transaction. So right now, one word, you wanted me to be concise, it's appetite. It's what is the market? Yep. What can you get off your lines today, right now, quickly?
Right.
To Rob's point, I like what he said. What is this product? What is this pool of loans? What is it worth? And is it real? And can I get that for it? So it's appetite. In one word, it's appetite.
Great. This should be a quickie, and actually it's a good question. What do you think? Is the new 1003 still going into effect this year? Or are they going to push that since there's so much else going on?
They pushed it for 3 years. So when they say November 1, they mean November 1. You have limited rollout that's going to happen between June and September, but the new 1003 absolutely goes live November 1. It's going to happen, folks. I've been telling you that for 3 years. It's going to happen.
Got it. Okay, so again, we had this question last week about equity lines and whether or not they're going to be frozen like they were in 2008. So the question is, would you advise your self-employed client who own a company that's not considered an essential business to take out all the money on their equity line now instead of doing it in parcels? And then they said thank you to everybody on the webinar for all your hard work. So thank you again, guys. And I just want to take a moment to thank Megan Jackson, who is always the lady behind the scenes who's facilitating all this for us. So thank you, Megan. So again, I know this is a landmine, but take out all the money on your equity line. What do you say? Go, guys.
Rob?
Okay, you don't have to answer. Yeah.
All right. Yeah, Rob and I've been around for a long time. I've been doing this now for 40 years. I don't know how long Rob's been doing. He's a much better looking, younger guy. I don't know if he's been doing it that long. But yeah, we remember back in the day when, lines were cut off, lines were reduced. Hey, we're going to, take your $100,000 line of credit. We're going to, melt it down into something smaller. We remember that. It's kind of out of my wheelhouse, Rob, so I'm going to defer to you, sir.
Well, no, I mean, I literally said that. I think that as we've talked about, this crisis, what we're going through now is different than 2008, 2009, 2010, which took a long time, to deteriorate. This has been within 3 or 4 weeks, 5 weeks. And to David's point, I hope that we bounce back. I haven't heard of, and I'll admit my deficiency here. I'm remiss in watching real estate values, but I haven't heard of anything like catastrophic happening with real estate values. To the best of my knowledge, a house worth $300,000 3 months ago is still worth about $300,000. It's not worth $200,000. And I think that I don't see the deterioration in values with this. I think that a lot of the industry looks at why we're here, which is this pandemic, and the market reacts right now. For a while there, the market was reacting to Brexit news, and before that, it was pigs. Remember Portugal, Italy, Greece, Spain. The market tends to react to certain things. Right now, as it should be, the market is reacting to what Donald Trump says about, breathing chlorine gas will cure whatever, or it pays attention to the health statistics that we're seeing out there as well it should. And I think that good news from the health area, I think that we will come back, and I hope that this just is a pause. I don't see property values, doing what they did in 2008, 2009. You don't have the stated issues that we had there.
Right.
You don't have lenders, I hope, lying about the makeup of the loans and the securities that were bundled with a bunch of subprime securities and sold off as a paper. I like to think that we don't have those basic problems that we had 10, 12 years ago. This is a problem that was created by a health crisis that will eventually, I like to think, will go away, and I like to think that we'll come bouncing back. I don't see the need to go out and tap into my home equity, my HELOC line, but that's just me. Well, I just went off for 2 or 3 minutes on that and watch, the exact opposite will happen and blah, blah, blah. And you'll come back to me, in 2 months and say, Rob, this is from the listener who asked about, taking money out for a business, and you were wrong and you cost them,
right.
Bankruptcy. I hope that doesn't happen. I just don't see the situation like the situation was 10 years ago.
Right. Well, I think if somebody needs to take money out of their equity line, they do it with the intent of paying it back. And I don't think that as loan originators, we can advise them on whether or not they should be doing it. I think they're going to have to take that on themselves, the borrowers. Okay, so there's a couple quick things that I think we can cover. One of the questions was, will Dave be doing online continuing ed course similar to the one you do each year in Petaluma? The answer is Dave is always doing online education. I'm going to answer this. Doing online education, a 20-hour online webinar on May 1st and 2nd. The flyer is going out today. Dave has a whole slew of other classes that we're going to be promoting with them and through camp. And then as soon as we can get back on the ground and do those in-person classes, we're doing it. Right, Dave?
Yes, ma'am.
Perfect. Okay. So they came out and said that realtors do qualify for the SBA loans, the business loans that don't have to be repaid. Do mortgage brokers qualify? Do either of you know the answer to that?
You want me to go first?
Well, only one of you gets to go because we're running out of time. So do they qualify, yes or no? And do they apply as business or an individual?
No, business, because again, SBA, Small Business Administration, But yesterday, within the hour of the program being rolled out, a particular large bank, and you guys know who the big ones are, they had over 60,000 applications for that SBA loan. So that was after an hour. There's going to be a lot of people who are applying for this. So if you are a small business and you wish to apply, then do it sooner than later.
I actually,
it's not. They keep changing the rules too, actually. So you got to stay up on that.
Yeah, not that I want necessarily more emails in my inbox, but somebody wrote to me yesterday, and he is actually helping. He wants to place an ad in my commentary to help lenders apply for that loan. So if you want to write to me, shoot me an email, and I'll hook you up with the fellow, and you could converse with him.
So we have a comment. I had a borrower ask the servicer for a forbearance, and the servicer told him he'd have to go delinquent first before he could get one. And I've heard that too. So it's going to be interesting to see how this plays out. Again, we are literally at the end of this. So just know that time-wise that is. Good Lord. Yeah, we have a lot of questions still. So we will come back to them next week. Just to wrap things up, since we are down to the last 2.5 minutes.
Yeah, Audrey?
We're yes.
Maybe all those questions can be directed to David at davidluna.com. Dave, what's your email?
Oh, you're so sweet. We will definitely get the questions answered.
Here, Mr. Chrisman, no fruit basket for you.
We've had some requests for a non-QM seminar or webinar. I am definitely working on it, but we're just trying to let the dust settle a little bit so that we get those who are really going to be in the game long enough to fund your loans to come on the webinar. So just give us a little time on that. It's on our radar for sure. And we have Barry Habib scheduled for next Monday at 11 a.m. Dave Luna will be joining us on Tuesday at 11 a.m. And we are continuing to roll out more information for people as it becomes available. So do you have any last comments, guys?
I'll go first, David. I know we're running out of time, Audrey, but I think that we have to keep our eyes on the horizon here a little bit. It's very easy to get caught up in the weeds here and the details, but I mean, remember who we're trying to help. We're trying to help borrowers. We're trying to help people buy homes, and people still want to buy homes, and people still want to move out of their apartments at some point and move into some nice school districts. And I think that the things that we do now, things we'll do in the future. I mean, the world and the nation needs this industry to help them buy homes. So I think it's, I hope this is a short-term blip and we bounce out of it, but I think it's good to keep in mind who our clients are. So I'll turn that over to David.
I think we need to set expectations right now because of the volume, the sheer volume going through the system. I think we just need to set expectations with the borrowers. Borrowers, you're going to get a fabulous rate, but it's going to take time to put it together. And again, if they didn't get it at the lowest point, oh my goodness, to have a quarter to even 0.5% off of the lowest rate that the industry has ever seen, I think borrowers should be happy. So I think set expectations is my last two words.
Great,
Audrey,
and I agree that we keep our eye on the horizon. I have borrowers calling me going, as soon as this is done, I'm buying a house. I can't be in this tiny apartment with my wife and kids anymore. I need a bigger place. So we will have plenty of business. I would just say one more time, support your trade organizations like the California Association of Mortgage Professionals and National Association of Mortgage Brokers, so that we can continue to do these kinds of webinars to keep you informed. So have a great day and a great week, and we will see you next time. Thank you.
See you later, guys. Bye.
Bye, guys. Thank you.